Hey guys, it's David Barnett from davidcbarnett.com, the blog site, YouTube channel, iTunes, and SoundCloud podcast where I talk about buying, selling, managing, financing small and medium-sized businesses and any other questions that you guys ask me. This is a look at the page right here. Don't forget, in May, I'm coming to Toronto. If you click there, you'll get information about that. And down here in April 17th to 19th, I'm going to be in St. Louis, Missouri, along with 19 I guess there's 19 speakers, so I guess 18 other speakers in addition to me over 3 days. If you own a small business and it's feasible at all for you to get to St. Louis, you want to check out this event. And I know there's special pricing that continues until the end of February. So you can actually save quite a bit by registering in the next few weeks. This week, I wanted to make a special video because I came across an advertisement on Facebook, I think. It was a boosted post from Scotiabank in Canada. And it piqued my interest, and I started to read the details, and I know that this kind of thing is happening everywhere in the world. So regardless of where you happen to be, it's important for you to notice. And like many bank, advertisements, of course, it promises money and easy to access capital for your business. This one is promising to get you approved for up to $100,000 of loans on the go. You get approved in minutes. You can draw as little as $100,000 up to your approved limit. And how does this work? So you get a global limit of up to $100,000 instantly upon approval. You have the flexibility to draw funds as you need them through individual term loans. So when I first saw this ad, I thought they were advertising a line of credit, like a $100,000 line of credit you would have from a bank. But when I started to read the details, what I realized is that they approve you for a certain amount, and then you say, hey, I need to buy a piece of equipment at $7,000. You carve out your own little $7,000 loan, all right? And when you carve it out, you determine the amortization, how quickly you're going to pay it back. Now, when you start to read the details here, it says it's flexible. You get to choose how much you're borrowing, and you get to choose the repayment period, right? So I could say I want to repay the $7,000 over 2 years, 3 years, 4 years, what have you. And it says payments are divided equally over the payment term as chosen by you. There's a little footnote number 3. And then it says that this is done in partnership with Cabbage Inc., which is one of those new fancy Fintech firms, which very carefully assesses you, your business, your social media presence, everything that can be known about you to make a decision. And these guys and services like theirs are being touted as the next kind of big thing in lending. And so, you read some more details. It says apply now, and there's a big footnote number 2. Remember, we saw number 3. And it says down here, number 1, subject to customer eligibility, must have a valid Scotiabank business account. You authorize Cabbage and service providers to look into you, blah, blah, blah. So what I thought was interesting, of course, is that only one of the footnotes is here. Well, we've already seen 2 and we've already seen 3. So let's open it up and see what they're hiding. Okay. Footnote number 2 says, in addition to banking transaction history and credit bureau reports, use of advanced data analytics, traditional and non-traditional sources may be used in the credit making decisions. So they're going to look at your LinkedIn profile probably, and they're going to look at your Facebook account maybe, and for that of your business. Number 3 is the interesting one. The monthly fee is determined from risk-based pricing and customer credit profile at the time the loan is created. So this loan does not feature an interest rate like we traditionally see with lending. Instead, it is a fee-based account. And whenever you start to hear about someone giving you money in exchange for a fee, what it should make you think of is those little payday lending stores down on the corner in the bad part of town, because they're the ones who pioneered this sort of thing. And it says, for example, if your initial loan amount is $10,000 and the fee is 1%, you will pay a fee of $100 every month that the loan is outstanding, plus the applicable principal repayment. So what they're saying is that if you borrow the money over 4 years, for example, then you're going to repay, an equal principal amount. But while you owe the money, you're going to pay 1%. So it's almost like, a traditional loan that amortizes over its life. The amount of interest you pay every month declines as the principal payments grow as the thing gets paid off. And what they're doing here is they're fixing the amount that they get. They're fixing their fee to you, regardless of how much money you still owe them. So they get to collect interest on the entire amount. Now, if you're familiar with how interest is calculated, a 1% a month interest rate would be equal to 12% a year, right? But that would only be 12% a year if you borrowed $10,000 on the first day of the month or first day of the year, and then on the last day of the year, you repaid the entire $10,000. You'd be paying 12% annual interest on that 10 grand. But that's not what happens here, because every month you repay part of the money. So if you watched my video a little while ago about merchant cash advance and how it's deceptively expensive, this is the same kind of thing, but it's not coming from some shady, merchant cash advance calling people over the phone, preying upon restaurants and other people who can't get credit. This is being brought to you by one of the big 6 banks in Canada. Okay. And so let's go over to Excel, because I want to calculate this. So $10,000 loan amount, if we use their example, and it's a 1% fee, and believe me, if they're showing an example of a 1% fee, you can bet that some people are going to have to pay a higher fee, right? But if it's a 1% fee, that's a $100 fee. And if we repay our loan over 12 months, we have to pay $833.33 a month to repay the principal. So this is straight loan repayment. But the payment, of course, is $100 more because we have to pay the fee. And if we work that out using the time value of money formula, what it gives us is 21.46% a year, right? And so let's try something else. Let's say if it was only a $7,000 loan. Ooh, 21.46, right? Let's say if it was a $20,000 loan. Oh, 21.46. What if it's over 24 periods? Oh, 21.57. In fact, just for fun, I already worked it out. So, 10,000 over 24 months, over 36 months, over 48 months, over 60 months, or over 72 months, you're either, up around 21.6%, or you might get down to almost 20% if you stretch it out over a long enough period. So clearly the technology, the advances, the super wow gizmo stuff being provided by these fintech firms is really just a way for mainline banks to get out of the interest rate doldrums. What's a line of credit cost people these days? If you've got good credit at the bank, like 6, 7, 8% on a line of credit, maybe. And this is a way to jack it up for people. Anyway, I just wanted to explore this with you guys because I knew that you would find it interesting. Don't forget, go to davidcbarnett.com, sign up for my email list if you haven't already, and you'll get interesting emails, videos, etc. delivered to you weekly at least, but sometimes when I have different thoughts floating around in my head, I send out things more often. And with that, we'll say goodbye and we'll wish you guys a great day. Talk to you later. Bye.